Welcome back to Kognito Key. Today, we're unpacking a financial instrument that literally sits right at the heart of our economy, Treasury Bills, or T-bills. If you want to understand exactly how the government manages its money and how you can benefit from the absolute safest investment category out there, let's dive right in.
So let's start with a foundational question. How does the central government actually raise short-term cash? I mean, just like any household or business, the government often faces temporary mismatches between the cash coming in and the cash going out. So what do they do to bridge that gap?
Well, the answer is Treasury Bills. T-bills are short-term money market instruments issued directly by the central bank on behalf of the government. Their main job is to step right in and curb those temporary liquidity shortfalls, basically keeping the economy running smoothly.
Now here's the really interesting part. How you actually make money. Because unlike traditional bonds, T-bills don't yield regular interest. Instead, they're issued at a discount. That means you buy them for less than their actual face value. But when they mature, they're repaid at par. So that sweet difference between your discounted purchase price and the full redemption value, that is your assured return.
You might think government finance is only for the mega-rich, but these instruments are actually highly accessible. The minimum bid to invest in a treasury bill is just 25,000 rupees. And if you want to invest more, you just do so in multiples of 25,000. It's a highly structured system that keeps the whole process incredibly clean and straightforward.
Okay, let's demystify some market jargon for a second. How do you actually hold a T-bill? While they can technically be issued as traditional physical promissory notes, today they're almost entirely digital. They're held in dematerialized form by crediting an SGL, or Subsidiary General Ledger account. It's basically a highly secure digital ledger tracking your ownership.
So who's actually allowed to buy them? The eligibility is incredibly broad. We're talking everyday individuals like you and me, private firms, large companies, and trusts. It also includes the heavy hitters, banks, insurance companies, provident funds, and even state governments. It really is a truly open financial instrument designed for wide participation.
Types of Treasury bills. The 3 auction timelines.
First up is the 91-day T-bill, which, you guessed it, completes its tenor in exactly 91 days. These are sold using a uniform price auction method, meaning all successful bidders pay the exact same price. The auction happens on a Wednesday, and if you're successful, the payment is made on the following Friday. It's a very tight, super predictable schedule.
Next is the 182-day T-bill, maturing exactly 182 days from issue. The schedule here shifts just a bit. Auctions still happen on Wednesdays, but specifically on non-reporting weeks. And just like the 91-day bill, when the term expires, payouts reliably hit your account on the following Friday.
Finally, we have the 364-day T-bill, maturing just 1 day shy of a full year. The auction method actually changes here to a multiple price auction. That means successful bidders pay the exact price they bid. These are held every Wednesday of a reporting week, with repayment dependably arriving, once again, on the following Friday.
Why invest in T-bills? The key benefits for investors.
So why choose a T-bill over other options? First and foremost, they are the safest investment in their category with literally zero risk of default. Second, they offer amazing liquidity in both primary and secondary markets. Third, there is absolutely no tax deducted at source, or TDS. Add in low transaction costs and high transparency, and you've got a phenomenal, secure instrument.
And that wraps up our deep dive. I hope this explainer made government finance a whole lot more accessible for you. If you found this helpful, definitely hit that subscribe button to join us here at Kognito Key. Like and share this explainer with your friends. Let me know in the comments what finance topic you want unpacked next. But I'll leave you with this question. With zero default risk and highly predictable returns, could incorporating T-bills be the missing anchor in your own financial portfolio? Keep learning and stay curious.